Hi, this is John Camarianos coming to you from Rehoboth Beach. Welcome to a new edition of Capital Considered. Today, I wanted to demystify a phrase often used in finance. Finance uses a lot of complicated phrases that really don't signify complicated concepts necessarily. So one of these phrases is sequence of return risk. That sounds really complicated. What the heck does that mean? It's not that hard, really. What it means is when you're retired and when you're drawing money off of your assets, bad years at the beginning can really screw up your retirement plan and really hurt your portfolio. Back in 2019, I wrote an article for the Wall Street Journal that illustrated this. I did a simulated retirement distribution plan. So someone distributing income off of their assets starting in the year 2000. And granted, I cherry picked a very bad time in the markets. The year 2000 was the start of the bursting of the tech bubble. And then we had another crisis, of course, the great financial crisis in 2008. But I think it's useful for investors to plan for worst case scenarios. And that's exactly what I did in this case. Let's look at this chart now, and it'll become more clear, I think, what I'm talking about. So we have three lines here. They correspond to three different portfolios, but every portfolio is doing the same thing. It's distributing 4% of the assets in the first year to the investor, and it's whatever dollar amount that is, it's adjusting that for inflation in the years thereafter. And I used the Minneapolis Fed because it has a good table of CPI numbers that you can get access to readily. So let's start with the orange line here, the scariest looking line. The orange line is just if you invested all your money, in this case, starting with $500,000 in the S&P 500. And you can see the drop in the beginning, in the first couple of years when the tech bubble burst, was significant, and the portfolio never really recovered. It stabilized, let's say, up until 2008, and then it dropped again. And then it's kind of hovering around $200,000 through 2018, where I stopped the simulation. So you can see an all-stock portfolio, when the stock market does badly, can hurt you in retirement when you're distributing assets. Now let's move to the second line, the blue line, the line in the middle. Again, we start at 500,000. We take the same exact distribution, 4% the first year, and then adjust that dollar amount every year thereafter by whatever the CPI was the year before, the Consumer Price Index. That's what CPI stands for. You can see that the line has the same general shape to it, but you lose a lot less money. You end up at the end of 2018 with a little over $400,000 from the 500,000 you started with, taking that 4% and then 4% plus inflation distribution every year. So that worked out well. The green line at the top is the most conservative portfolio. Again, same exact procedure. Start with 500,000. Take 4% out the first year, whatever dollar amount that is, adjusted for inflation every year thereafter. And that keeps you at around just over $500,000 at the end of 2018. So the most conservative portfolio worked best. When I wrote this article, bonds were paying nothing, and I got a lot of comments saying, hey, it's not the same situation now, meaning in 2019 as it was back then. But now in 2026, bonds are paying something again. So the whole point of this is to say to retirees, hey, maybe you should dial back stock exposure, especially when U.S. stocks especially look expensive right now. That brings us to another issue we should add about this study that I did. I just used U.S. stocks and U.S. bonds. I didn't use foreign stocks and foreign bonds, didn't use gold, didn't use any other asset classes, just U.S. stocks, meaning the S&P 500, and just U.S. bonds, meaning the Bloomberg U.S. Aggregate Index. But again, it's interesting to see that the more conservative the portfolio got, the better it held up during a bad period for the stock market. So, important for retirees to understand that when they're in distribution mode, meaning they're distributing assets to themselves, distributing income to themselves from their assets, they're in a very different position than young people are when they're in savings mode. Young people can withstand market downturns, and in some ways should hope for them because they're continuing to invest new money in the markets and they should hope for cheaper prices. Not the case with retirees. So I hope this is useful. It's just one simulation for one time period, but it illustrates to retirees that a bad stock market can hurt you, and you should check your stock exposure if you've just retired or if you're about to retire in the next year or two. Anyway, John Camarianos for Capital Considered from Rehoboth Beach, signing off. Thanks for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.